Hi everyone, Larry Bailey here with Mortgage Workflow Partners, bringing you another weekly market news updates. We continue to do these on the weekly to make sure that you understand exactly what's going on in the marketplace. Even though that might not be your primary job, it's still always important to understand what's going on. This happens to be the review for the week of June 23rd, 2025. We've got inflation coming in above estimates last week. We saw home sales stall. And this is really all around the following stories that focus on the Fed's preferred inflation gauge exceeding expectations in May. Meanwhile, the housing market that saw soft home sales, although the annual home prices, they continued to rise throughout the month of April. We're going to go into the following stories. The first one is inflation update with key measures slightly higher than expected. We've got existing home sales remaining sluggish in May. We've got new home sales slow. We've got annual home price growth decelerates, but still remains solid. Other economic highlights, we've got a family hack of the week, and then we're going to talk about what to look for this week. If you're listening to this on podcast, thanks very much. I always encourage everyone to get over to the masteringencompass.com community, and that's where you can see this full video replay. You can check out what's going on screen, including getting that recipe for the family hack of the week. And if ever you need anything to do with Encompass support, both for closed scope, open scope engagements, training, help desk, admin services. If it involves Encompass, we're your company. Check out. So let's get into these stories. First story here is inflation update. The key measure slightly higher than expected. We saw the latest personal consumption expenditure, that's known as the PCE report, which is a crucial gauge for inflation. We saw that showed headline prices rising just 0.1% in May, bringing the annual rate to 2.3%. These figures were mostly in line with what was expected. However, the focus is often at the core PCE. That's the part of the PCE which strips out the volatile food and energy costs. And this is the reason why this is because the Fed prefers this as its actual measure of inflation because it strips out the volatility. That core PCE increased 0.2% in May, coming in slightly above the 0.1% forecast. On an annual basis, the core PCE now stands at 2.7%, which is just above the 2.6% expected. A major factor keeping the core PCE elevated remains shelter costs. It's important to understand that the shelter costs take up about 18% of the core PCE calculation, which is significant. And while official government data shows slow improvement, real-time market data, things like Zillow and Apartment List, those suggest rents are actually softening faster than the official numbers currently reflect. And so all this together brings us to the bottom line of this story, which is making further progress towards the Fed's 2% goal for the core PCE might be challenging in the near term, potentially until early 2026. Here's why. The monthly core PCE figures from June through December 2024, that will drop out of the 12-month calculation. Now, what's interesting is back when we were doing these back in just coming out of the pandemic, where we saw the super high inflation numbers rolling off, which brought down a number, now we're starting to see that come back to light. And so those June through December 24 numbers, which are going to roll off, those were already relatively low, ranging from 0.1 to 0.29%. This makes it harder for the upcoming monthly price changes to significantly lower the annual rate, because if you replace 0.1 with 0.1, you got no change. So looking ahead, the picture could improve in 2026. The monthly figures from January and February 2025 that will also drop next year were higher. That was 0.34 and 0.48 respectively. Replacing those higher numbers with potentially lower monthly increases should make it easier towards that Fed's 2% target. We shall see. Next story. Existing home sales remain sluggish in May. We've got some existing home closings saw a slight increase in May, rising 0.8% from April to an annual rate of 4.03 million units. While this was better than expected, it was the weakest sales pace since May of 2009. Meanwhile, pending home sales, which is a key indicator for tracking signed contracts on existing homes and forecasting future closings, that rose 1.8%. By the way, I think that annual rate of 4.03 million is a typo. I think it's actually an annual rate of 1.03, but I could be mistaken. It seems really high. No, it's actually 4. So I guess it is 4. It's really weird because we talk about, when we go into this story about, you know, they're still rising, although May was a notable drop. Lawrence Yun, the chief economist for the National Association of Realtors, that's the NAR, he had a quote of persistently high mortgage rates being the main culprit behind the subdued sales activity. Lawrence expects that the sales will rise if mortgage rates fall in the second half of this year. As for inventory, the number of homes for sale available rose to 1.54 million units, which is an increase of 6.2% from April and 20.3% higher than a year ago. So inventory is up 20% year over year. However, the supply is still significantly lower than pre-pandemic figures and far from the 4 million units seen during the housing bubble. So I'm going to go back a second to this whole idea of mortgage rates being the problem for sales. I disagree with this personally. Affordability is a problem. When you look at, so I'm in southern New Jersey. I've said this a bajillion times. I'm in southern New Jersey in a town called Hainesport. I raised my family in a town called Medford, which is about 15 minutes that way. The difference in affordability between our two towns is significant. My property taxes are about $8,000 a year, which I know might sound like a lot to some. In the past, it was like super high. But Medford, this house in Medford, our taxes would be almost double. So $16,000. Same square footage, different school system. They have a full-time police department. We don't. They have a full-time fire department. We don't. Their population is probably maybe double, right? Land mass square footage wise is, I don't even know what it is. It's bigger. My point is, though, that when we're talking about mortgage rates, the difference between getting a house here at 7% interest rate and getting a house there at 3.5%, would it be cheaper there? No, it wouldn't be, because the property taxes are higher. And also the insurance is higher too, because of where that is. So my point for affordability is my rant on affordability. Yes, mortgage rates are higher than 3.5%, but there's still average mortgage rates as they've always been. If you look at the math, the average mortgage rate is somewhere around 6.5% historically. And this includes when they were 17% and when they were 6% and when they were 3%. So I balk at the idea that Lawrence Yun has the reason why things are slow is because of mortgage rates. It's just easy to pick on, Lawrence. If you really want to tackle this problem as a society, it's affordability, which goes into insurance. There's housing in high risk areas for insurance where the insurance is causing homes to be unaffordable. You've also got issues of condominiums where condominium associations have to go out and get this crazy kind of insurance, again, in these high risk areas, and that's making things unaffordable. And then you've also got property taxes continuing to go up around the country. Some places that used to be really low property taxes where it was a couple thousand. We went out and looked at housing, again, in a town that way, where taxes were like $5,000 a couple of years ago, and they reassessed the whole town. Those taxes literally doubled, where those taxes are now $10,000 or $11,000. So again, my rant on this story is affordability is way more than just mortgage. So I'm just kind of tired of hearing folks like Lawrence Yun specifically call out the reason why we have problems is because of mortgage rates. I disagree with that, as I've said. So let's get back to the news here. Let's get back to the market updates, shall we? So we've got new homes sales slow. This next story talks about new home contracts pulling back sharply in May, falling 13.7% from April. It's huge, to only a 623,000 unit annualized pace. This pace missed expectations and reached the lowest level since October. Despite the significant monthly drop, sales were still only about 4% below the monthly average pace seen in the first quarter, which was 654,000, and down 6.3% compared to a year ago. So in this story, the bottom line is the total number of new homes available for sale reached 507,000 at the end of May, which was the highest amount since November 2007. That's good. However, it's important to look at the details. Only 119,000 of this 507,000 were actually complete and ready for immediate move-in. The others were either still under construction or not even started. They're still dirt. So still under construction, 271,000, or they're just dirt, 117,000 units planned. So despite the overall inventory number, the market still needs more readily available supply to meet buyer demand. Obviously, nobody's going to move into dirt or a partially constructed home, especially given the historic shortage of existing homes for sale. All right. Next story here is annual home price growth decelerates but remains solid. So we see some information here. This is a widely watched Case-Shiller home price index. It's also often called the gold standard, quote unquote, for tracking home values, and it showed that the nationwide home prices rose 0.6% from March to April before seasonal adjustments, though they slightly declined 0.4% after adjustments. The difference occurs between prices that typically happen increasing in spring and then seasonally adjusted for other seasons. Looking at the bigger picture, the national home values increased 2.7% compared to a year ago. And this is a bit slower than 3.4% annual growth that we saw in March. The major urban markets continue to outperform the national average, with the 10-city composite index rising 4.1% and the 20-city index up 3.4% year over year. The FHFA, that's a federal housing finance agency, that price index showed a similar trend where prices increased 0.6% before seasonally adjusting, but they're decreased 0.4% after the adjusting. So with a 3% year-over-year gain, that was the average. It's important to note that the FHFA only tracks homes with conventional mortgages, does not include cash, does also not include loans that exceed conventional limits, as opposed to Case-Shiller, which includes everything. Bottom line, Case-Shiller noted that, quote, housing supply remains severely constrained, close quote. Many existing homeowners are also holding on to their low pre-pandemic or pandemic era mortgages. Those are rates under 4%. And while new construction is not keeping pace with demand, all of this is providing for this pressure. The shortage of housing supply continues to support home prices and is helping prevent the decline some analysts had anticipated. All right, we've got some other economic highlights here. The U.S. economy contracted. We got a report that the U.S. economy declined by 0.5% in the first quarter of 2025, according to the final GDP report. So that number's it. That's the number. It contracted, period. This was larger contraction than previous estimates of negative 0.2%. The decline was primarily driven by increased imports ahead of tariffs and reduced government spending. However, growth in investment and consumer spending provided some offset to that. Otherwise, it would have been worse. The next economic update is jobless claims trend higher. We saw jobless claims continue to show a rising trend, particularly for those already receiving benefits. Initial weekly claims, fell slightly by 10,000 to 236,000, but this figure remains elevated compared to earlier this year. Most notably, continuing claims surged by 37,000 to 1.974 million, reaching the highest level since November of 2021. Continuing claims have now been above 1.8 million for over a year and above 1.9 million for 5 consecutive weeks. Hey, did you know July is National Watermelon Month? I didn't, but now I do. So here's a family hack of the week. Here's a recipe on screen. If you're listening to this on podcast, head over to masterencompass.com. Check out this spot in the replay. Check out the watermelon recipe where you've got some watermelon popsicles from all recipes. Here's what we're looking for this week. We've got a busy week, gang. We've got market updates are scheduled for before the markets close on Friday in observance of an Independence Day this week. On Tuesday, we get job openings data will be released, followed by ADP private payroll figures on Wednesday, followed by Thursday. You'll see both weekly jobless claims and the comprehensive employment report, which also includes non-farm payrolls and the unemployment rate. So lots going on here at the end of June. Hope you guys make it a great week. My name's Larry Bailey. Thanks very much for listening. We'll catch you on the next one. See you now.